Win Thin is our next speaker. We're going to focus on emerging markets with him. Win Thin is the global head of emerging markets at Brown Brothers Harriman, and he'll talk about the new normal. If I could ask you to come here.
Hi there. That was a fascinating talk. Unfortunately, I'm going to head right to the bar after this because I'm going to try and cheer you guys up. I don't think I can do it after what I have to tell you about emerging markets. I work at Brown Brothers Harriman. We're a small, privately held bank. In 2018, it'll be our 200th anniversary. So I like to think we do things the right way, the old-fashioned way. Our clients are mostly real money managers, that is, the Fidelities, the Vanguards of the world, insurance companies, pension funds. We have really no hedge fund business to speak of, no corporate business. Our niche is helping global investors invest globally. I work on the foreign exchange desk. So when we see, for instance, when I see a Brazilian real deal, it's not a speculator that's trying to bet on where the real is going. We're basically funding a purchase, say, of a Brazilian stock or Brazilian government bond. Korean won could be buying shares in Hyundai. But our job at Brown Brothers is to help facilitate investment transactions across borders. Myself, as a fundamental economist, my job is to help identify what I would call risk. And what I see as risk is somewhat different than what I think we've talked about in the past. What it might be very different from what a multinational corporation would see as risk. But there's a bit of an overlap in the Venn diagram. I try and identify economic risks, political risk, transactional risk. We have a whole department that's basically geared towards just fundamentally funding the transactions. What forms have to be filled out? What accounts have to be pre-funded in order to buy stock in say, Indonesia? We trade nearly 100 currencies, foreign currencies on our desk, on the FX desk. But I can count on my two hands the number of currencies that are freely tradable. That is, as any entity can just go in and buy and sell, say, a Mexican peso. Most of the time, 9 times out of 10, they're what we call heavily restricted. We have forms that have to be filled out with the central bank or with the Securities Commission. And this is something that grew out of the Asian crisis. Before 1997, the Washington Consensus was to make your currency freely tradable. And by the way, thank you for breaking the ice. I'm going to trot around a little bit. The Washington Consensus pre-Asian crisis was basically open up freely convertible currencies, freely tradable, open up your capital account, that is, let anyone come in, buy and sell your currency, and everything will be hunky-dory. Well, as we saw in 1997-98, most of these emerging economies were not prepared for the massive amounts of global capital flows. They just move every day. I believe, I'll have to check, but I think the latest survey, I think, is $5 trillion a day trades on the foreign exchange market. It might have gone up, I'm not positive. $5 trillion a day. So we see more in capital flows in one day than we see in global trade in a year. So we came out of the Asian crisis realizing that, you know what, this is probably not the right thing for most of these countries. And most of those countries have stepped back. Malaysia, Thailand, Indonesia have all made their currencies more restricted. That is, making it more difficult to short the currency or to sort of cause or lead to sort of these economic crises. And to be honest, you can't blame them. And I think the IMF and what you call the Washington Consensus has finally sort of signed off on this. And they recognize that, you know what, developing economies are not equipped for these massive amounts of capital that are sloshing around. So again, the exception, or rather the rule, not the exception, is highly restricted currency and capital markets. Yet despite that, capital flows still go. I think one of our biggest currencies that we trade on our desk is the Indian rupee. One of the most restricted markets, one of the most difficult markets for foreign investors to invest in, and yet people still go there because it's a good story there. And so there's still capital movements, but I think what we're seeing is more control, more restrictions, and that's something that I think has made it more difficult for foreign investors. So again, my job is to help people decide, well, what countries are good, what countries are bad, what countries you have to worry about, and bank as a whole is to just help facilitate these sort of capital flows. So I've been following emerging markets since the 1980s. I've seen the Latin American debt crisis, the Asian crisis, I think they called it the tequila crisis back in '94. I've seen it all. And I think what we've seen over the last 10 years is that markets really became a little bit more too complacent on emerging markets. There's a reason they're called emerging. They haven't emerged yet. There's still issues. So for the last 10 years, I think we had a lot of global investors coming in that just really had never seen a real crisis before in emerging markets, and we got too complacent. So really, emerging markets is coming off a really 10-year sweet spot built on 4 pillars. We had a weak US dollar, low US interest rates, that means a lot of capital is flowing out of the US and out of the developed world into the emerging markets, strong global growth, this is when China was growing 10, 11, 12%, and high commodity prices. Remember the days of oil around 150, of course, could go and nowhere but up. So everyone bought into the story, and oil at 150, that will do wonders for an economy. All of a sudden, your current account moves into surplus, you're running budget surpluses because you're getting all this money coming in, currency strengthening, inflation goes down, so it's a very virtuous cycle. But I think what many investors, and I think I'm guilty of this as well during this, is that it wasn't a structural shift. It was really a cyclical boom, it was, albeit a very extended, nearly decade-long structural cyclical boom, but it was cyclical. So what goes up must come down. So since 2014, we've really seen the air come out of the emerging markets. We've seen the dollar come back. The dollar is now stronger than it's been in a while. We'll see that chart later on. US interest rates are starting to rise. All of a sudden, capital is starting to come back in the US. Global growth is slow. IMF each quarter keeps marking down the global growth forecasts. And commodity prices are suffering. Copper, iron ore, oil, across the board. So, this is, again, a cyclical thing. This doesn't mean it's the end of emerging markets, but we're dealing with a cyclical move. We're on the downside of that cycle. I don't know how long it's going to last. I would eventually guess it's going to be several years. We're sort of more close to the beginning than the end, I think. So that gives me, I think, a lot of room to help sort of navigate. I think the days of the easy money are over. From 2004 to 2013, you could just throw a couple $1 million here. Any country, you could just almost pick it on a map, and you expect it to rally because we just had this huge commodity-led boom, strong global growth. It wasn't just the commodities because then you had China that was churning out electronics, autos, et cetera. So it was really, again, a sort of a nice virtuous cycle, and we're seeing the downside of that now. So, I would say I'm fairly negative on emerging markets the next year or two. I don't think it's a disaster. I think the one thing that's better now than we saw, say, back in '97, '98 is that what they learned out of that Asian crisis is that fixed exchange rates are really not that good. That is, it's become more of a shift towards floating exchange rates because it acts as a shock absorber. And when you have a peg exchange rate, you're fighting to keep that peg there. All of a sudden, things turn, commodity prices collapse, say, and when that peg collapses, it's disaster. We saw that in '97 when the Thai baht broke, Indonesian rupiah, Korean won, Russian ruble, on and on. Very, very disruptive. And that's not the end of the world, but it's much more disruptive than when you have an exchange rate that's freely floating. That's, again, it's like a shock absorber. So we've seen emerging market currencies weaken really quite significantly over the last year or two. And that's actually a good thing. It reflects the terms of trade movement against them. That is, the prices of their exports have fallen, so their currencies will naturally weaken. And eventually helps the economy adjust. So why am I negative on the emerging markets? Well, we saw all those factors that I think will persist. We're seeing oil, copper trying to bottom, but if you look at the supply-demand dynamics, there's still a lot of supply out there. Saudi Arabia, Russia, they're all pumping oil like there's no tomorrow. In terms of copper, I know Peru is bringing, I think, 3 or 4 massive copper mines online this year. And that's the problem with the commodity boom, is that a lot of these investment decisions were made 3 or 4 years ago when commodities were booming. They sunk billions of dollars in these projects, and they still have to bring them online. Even though prices are low, it makes sense to still bring these online. So we've got massive supply overhang and sort of weakish demand outlook. Given what we see in global growth. So, again, it's not the end of the world for emerging markets, but it's just making it much more difficult for policymakers, making it much more difficult for investors. The other thing that I think that's sort of the other shoe to drop out there is the Fed. In the past, historically, the start of a tightening cycle by the Federal Reserve typically leads to stresses on emerging markets. And that's part of the reason it's the money that flows out of emerging markets back to the US. You kind of come back home. There's a whole sort of recalibration of risk and reward. But typically, we've seen some stresses, and we saw that. We saw that last year. The Fed hiked in December. In January and February, we saw a lot of stress and turmoil for a variety of reasons. But I think much was linked to the Fed tightening cycle. Now, what's changed since then? Well, over the last 2 months or so, emerging markets has gotten some traction. That's because Ms. Yellen, at her March speech at the Economic Club, actually I was there, she was shockingly dovish. She was basically saying, you know what, we don't really need to hike that fast. There's a lot of slack in the labor market. We're going to be very cautious. She said cautious about 100 times, and cautious and gradual. The Fed met the week after that, in March, gave that same very dovish speech. So that's helped calm matters. Emerging markets have gotten some traction. Equities have gotten traction. But I think it's temporary. If you look at this chart, those lines are what you call the dot plots. That after every quarter, the Fed releases what they call a dot plot, which is the median projection of where the Fed funds rate will be at year end. And you'll see over time, the Fed has always been too hawkish, and it's adjusted it several times, actually every quarter, since early 2015. That yellow line is the interest rates that are implied by the Fed funds futures market. That is, what are markets betting on, rates being at the end of the year? And it's hard to tell. If you look at it closely, the markets are pricing in one 25 basis point hike this year, one 25 basis point hike 2017, and 125 basis point in 2018. Now, if you flash back to 2005, 2006, that was the last Fed tightening cycle. They hiked every meeting. So they meet 8 times a year. So they're hiking 2 percentage points a year. That's sort of what you would call a normal Fed tightening cycle. Well, we're not in a normal cycle. We're coming out of a very deep economic global recession. So we knew ahead of time that the Fed tightening cycle was not going to be your normal, sort of quote-unquote normal cycle. But I think personally, and as an institution, we think this is too dovish. 125 basis point hike per year, that's really nothing. It's like pushing on a string. So I think the markets are massively underestimating the likelihood of Fed tightening. And I think there's going to be some turmoil. The next meeting that people are talking about is the mid-June meeting. Basically, no one is pricing in a hike then, but I think there's a decent chance that they do. We'll know a little bit more tomorrow. On Friday, there's the jobs data that comes out for April. What's interesting is that the jobs market is still pretty strong in the US. Growth has hit a soft patch, but unemployment is below 5%. So I think that, again, markets are underestimating the strength of the US economy, the underlying strength. I'm fairly upbeat on the US. And I think the Fed tightening cycle is going to be much, well, I won't say much, but it will be more than what the market is pricing in. And that could cause some turmoil. Once the Fed tightening cycle story comes back, we think the dollar will continue to rally. If you go back, this is since 1980. There have been 3 major dollar rallies since the end of Bretton Woods, the end of fixed exchange rates. The first one is what we call the Volcker Rally. That's when he hiked rates up to about 20-something% to choke out inflation after the first oil shock. This we call the Clinton dollar rally. That's when we had sort of the dot-com boom, a lot of money flowing into the US. And this is what we call the Obama rally, which is, I think, predicated on a good US economy, tightening by the Federal Reserve. The one thing that's interesting, I'm not going to spend hours talking about this, but there was something interesting that even though the Fed is only maybe they hike 50 basis points a year, 75, the rest of the world is still easing. Japan, they just instituted negative interest rates. I can't even get my hands around that. They're basically paying the government for the privilege of borrowing. It doesn't make any sense to me. And I think there's all sorts of academic literature that's going to come out of this. Is what are the real costs of negative interest rates? There's so many distortions that we've yet to really explore. I don't think it's good. I just don't think, it's not natural. But the fact of the matter is the rest of the world is still easing. Bank of Japan, ECB, is just announced another round of easing in March. So the US to me is really like the one, it was sort of the first in and first out. Maybe they took all these really aggressive, they went to QE back and zero interest rates back in 2008. They were the first to do that. The ECB just did quantitative easing last year. So they're a little bit late to the game. And that's why I think the dollar should be the first to sort of come out of this. That's going to be stressful for the emerging markets. One thing, I'm sure you've read about this in a lot of the press and it's been out there, is that a lot of emerging market corporates and sovereigns have borrowed in dollars, foreign exchange. Some people call that the original sin for emerging markets. That is that this whole imbalance in your sovereign balance sheet. And when you have a strong dollar, and all of a sudden it costs, if your currency weakens, it costs you 20% more to service this dollar debt. So that's something to keep an eye on. Again, I do think the fact that we have these freely floating exchange rates will help the adjustment process a little bit more. It can help companies hedge the foreign exchange risk, do some prepayments, et cetera. It's just not as disruptive as a fixed exchange rate breaking. Global growth. I touched on this earlier. So between 2003 and 2007, global growth averaged about 5%. 2008, 2009, we obviously saw the downturn from the global financial crisis. And if you look, we've really seen sort of a real market slowdown in global growth. That's the red line. And the IMF is forecasting a pickup in 2016, 17, and 18. And I think it's being too optimistic. We're seeing Japan struggling. The US economy, we're not going back to 3%, 4% growth. China, the world's second largest economy, we're talking about 6.5% if we're lucky, not 10, 12 that we saw before. So I just don't see this. And I think every quarter the IMF updates its World Economic Outlook, and every quarter they mark down their forecast. So I fully expect this. This blue line is the median forecast of Wall Street analysts. And it's a little bit more, I think, realistic, a little bit more pessimistic. But even that, I'm not sure where this growth is going to come from. China, we know, is in a structural slowdown. It's moving from an export-led model of growth, generating 10, 12%. In fact, I get asked that a lot of times. They ask, well, can China, make this transition from export-led to domestic consumption? I say they don't have a choice. Global growth is sluggish. We're not going back to the old days where you can run a weak currency and export your way into prosperity. It's not coming back. At least not for the next several years, if ever. I don't want to get too, I don't want to pile on the bad news too much. But look, honestly, it's a new normal. And it's not just for emerging markets. I think it's for the rest. It's really for the world. We're coming out of this very, very deep global financial crisis. And it's a big argument now. And I'm on the fence. Are we forever locked into this slow growth, low inflation mode? Or can we get back to some sort of robust growth that we saw sort of in the boom years? I don't know. I'd like to think we can, but it's hard to see where that engine of growth comes from. Every country you look at is struggling to grow, struggling with deflation, struggling with excess capacity. So it's easy to get kind of downbeat on the economic outlook. But that said, I think relatively speaking, the U.S. looks good, and I think the U.S. is going to help the global growth outlook, help the emerging market story, and pick up some of the slack. But again, it's not going to be easy. Okay, let's talk about China. So that's the global backdrop for emerging markets. So not so great, right? Not great, not horrible, but not great. China. I think this is sort of the 800-pound gorilla in the room that everyone's always, we know it's there, we know there's problems there. People have been calling for a disaster in China for years. Something's going to blow up. The banking system, the corporate defaults, et cetera. I would just say this, if anyone tells you that they know what's going on in China, then they're lying, okay? Because no one knows what's really going on there. The data is fuzzy. I'm not even sure the policymakers know what's really going on there. There's so much going on there that we don't know about. We don't touch the surface. But what I can say with confidence is that I think they have the wherewithal to avoid what you call a big blow up, a big hard landing. I'm not saying that's not being particularly bullish on China. I just think they have the resources, they have the regulatory power, et cetera, to sort of prevent a big disaster in China. So that's just the base case. I sort of say, okay, China, I can't get wildly bullish on it, but let's just sort of tuck it in the back. And every now and then it's going to flare up. There's no doubt about that. People are nervous. It's the second biggest economy in the world. No one really knows what's going on there. We know the growth numbers are overstated. How much? I don't know. That's anyone's guess. So what you see is, obviously, we had these years where it was growing 10, 12, 14%. That all coincided with the huge commodity boom. Had a downturn from the financial crisis, bounced up for a little bit, but then since then, 2009, we've been really slowing, secular slowdown. And again, I think that's part of the fact that the global growth is slow. China cannot just sort of churn its way out of slow growth anymore. So hard landing, no hard landing, but a longer and deeper slowdown. And that's going to prevent the commodity story from really getting much traction. So this is just an illustrative. I mean, you can run all sorts of correlations, but I just want to throw this chart up. This is basically, the white line is Chinese GDP growth. That's the right-hand axis. And that's the price of WTI oil. So, it's obviously not a one-to-one thing, but you can see how the China story is really a big part. I did that with copper and iron ore, and it's a very similar chart. Strong Chinese growth is really a big part of this cyclical boom in emerging markets, and it's just not coming back. So risk. Okay, one thing I forgot to say about risk. As an investor, you can accept higher risk, but you got to get higher return. So that's sort of the, whereas risk for, say, an insurance company or multinational, it's a little different. For us, it's okay, well, you can say to an investor, well, okay, it's kind of risky, but you know what? You're going to get paid 12% yield, so why not worth it? It's kind of worth it. So it's all about risk-reward, relative value. What's the better, sort of risk profile, return profile? Very interesting way of thinking of things. I mean, I got my PhD in economics. I was very prepared to go. My father worked for the IMF, so I thought I'd go to World Bank or IMF or something like that. But I started working on Wall Street, and just sort of fell in love with this. Really fascinating, to me, a fascinating combination of economics and markets, psychology, things like that. Ratings downgrades. Well, this is probably something that you might be interested in if you're an insurance company, if you're a multinational. So far, this is just in 2016, just 4 months basically. We've seen 12 negative and 1 positive rating actions in the emerging markets. And I list all the countries that are commodity-based. I mean, a lot of these agencies are saying explicitly, these countries are going to suffer from lower commodity prices. They're not well prepared for sort of the downturn. I think the problem that we saw in emerging markets during this boom is that as commodity prices went up, a lot of these countries kept spending more and more. So you have what you call these break-even prices for oil and commodities. Like, what would the break-even price need to be in order to balance your budget? And we just saw it go up and up and up. As the price rose, so did spending. So a lot of these countries are paying for it. But it's not just the bad, so what you call the bad countries. Brazil, Russia, Venezuela, obviously South Africa are basket cases in many ways. But Mexico, not a bad story. Others. Now that's in emerging markets. In frontier, just so you know, you have sort of these layers. You have the developed markets up here, Japan, Canada, Australia. You have emerging markets, those kind of countries. And you have what we call the frontier markets, which is sort of, if things go right, they'll sort of eventually move up and graduate into emerging market status. So these are countries as listed: Angola, Saudi Arabia, Kazakhstan, et cetera, et cetera. In frontier, we saw 31 negative and 4 positive, just this year, negative actions. And this comes after a bad 2014 and 15 too. I should have put the numbers up there, but it was also very bad as well. So I think the agencies are recognizing that a lot of these commodity-dependent countries are going to be coming under some stress ahead, given that commodity prices may not be rebounding anytime soon. I'd say the ratings could stabilize if the recent bounce in commodities is sustained, but that's still, to me, an open question mark. I actually have my own rating model that I developed over the years, and my latest one shows multiple candidates for downgrades. So it's not turning around yet. Again, I mentioned how high commodities, it helps your fiscal numbers, your current account, your foreign reserves, all that stuff. All that's reversing. Reserves are falling, budgets are going into deficit, current accounts are going into deficit, growth is slowing, inflation is rising. So you get the idea. And I'm just going to mention a few things. I mean, again, I think I have to stress that during this boom, this 10-year boom, a lot of investors really lost sight of the real risks in emerging markets. They took it for granted that you can just invest, you'll get X% return, you'll get your money out, everything's hunky-dory. And that's just simply not been the case. You've got rising default risk. I think Venezuela is moving on the verge of default, depending on where oil goes. You've got payment risk. That is, if you invest, we had problems for our clients in Egypt and in Nigeria this last year. Investors, easy to get in, but when all of a sudden you want to get your dollars out to repatriate, you couldn't do it. You had to stand in line at the central bank, basically. That's payment risk, transactional risk, default risk, and just have general risk to asset prices. If you have a coup or a terrorist attack or something, that's of course going to affect markets and sentiment on a country. So I'm just going to run through a few. In Brazil, I'm sure you've been reading all about it. For 10 years, Brazil could do nothing wrong. Part of that was based on the high commodity story. And all of a sudden, commodities collapsed. President Rousseff and the PT tried to maintain these, what I think, excessive spending policies, and the bottom just fell out. All of a sudden, the corruption was exposed. So really, when the tide goes out, you really do, it's that old saying, you really do see who's wearing swimming trunks and who's not. We're getting to that point where we're really seeing the really bad sort of stories in emerging markets develop. Peru is the second round presidential vote on June 5th between Keiko Fujimori, the daughter of the old president, and a more market-friendly gentleman, Kaczynski. Venezuela, we've got if I remember, the opposition took control of the Congress several months ago in elections. President Maduro is fighting them. Political turmoil, basically political stalemate. Oil prices low, potential default risk, just disaster. I think inflation's up to 150%. Capital controls, you name it. South Africa, President Zuma is under fire for corruption. Apparently some political favors were promised by an influential family in return for naming the finance minister. Turkey, President Erdogan, he's consolidating power. If you know this, I think Turkey is the country with the most jailed journalists in the world. Now, that's something to be proud of. It's pretty bad. Then you have the whole Kurdish-Syrian situation. It's amazing. Poland, which we used to think was a sort of an island stability, well, all of a sudden, the Law and Justice Party just won. And they've been taking what you would call some questionable moves, installing cronies at the heads of the state companies, questionable judicial appointments, et cetera, et cetera. Malaysia, 1MDB, that's the Sovereign Wealth Fund. You probably know there's been some sort of question about $680 million that somehow appeared there in the bank account of the president. Philippines, the presidential election is this weekend. So these are just these are kind of things that you just have to really think about. And again, I think during that whole EM boom, I think people were very easy to overlook that. That is, I think in a sense that global investors did not, if you were to say investing in Petrobras, well, during that boom, you didn't really think about the country risk, the political risk, because it was just a company, it was a Brazilian company. What we find in emerging markets is that really the sovereign is still the overriding story, and underneath that is the sort of the corporate story. You can't just buy the corporate story without knowing what the sovereign story is, what's going on politically, what's going on economically. I think that's it. That's a mouthful. Sorry. I could spend hours up here talking about each individual country. If anyone has any, and I apologize, I'm going to miss the Q&A. If anyone has any questions or issues, please feel free to email, I guess, you, and you can pass them on to me. Happy to respond.
Thank you very much.
Thanks. Thanks.
Thank you very much. We have 20 minutes coffee break, so if I could get you back like in 20 minutes, like 4:35, that would be great.